You may have heard of the common investment mistake, letting the tax tail wag the investment dog. I've seen this many, many times, and because the cost is almost insurmountable, I want to give a few examples so that you really understand what this means. So for example, let's suppose that you have a property that has gone down in value significantly, and you could lock in a $200,000 loss, and I so happen to have been in that position many times. And it's a great property with great prospects. Maybe it's going through some zoning right now, but you look at it and realize that you could sell it right now and lock in an ordinary loss if you're in the real estate business, or potentially just a long-term capital gain loss, in which case your $200,000 is going to take you a half a century to utilize the full losses. But a lot of people will want to lock in that loss so that they have that tax benefit for such a long period of time, or if it's an ordinary gain, they may want to take that right now, as opposed to letting that property come back in value. One of the ways to look at this then is not to say, okay, what am I going to get first from taxes if I sell this, but what will it go up by? What do I assume the property is going to be worth 5 years from now? Because ostensibly we're going to sell that, take the funds and put it into something else that's going to go up in value that will eventually probably create a capital gain of some sort. Let me give you a few more concrete examples. I was talking to somebody, a doctor, who spent $800 on something before year end, and I was looking at it. We were at church and he was showing me this $800 gadget. This was about 10 years ago, before everybody had smartphones and iPads. And it really didn't do all that much stuff, and he certainly wasn't mechanically inclined enough to do a whole lot with it. So as we looked at what it did, I asked him, what he paid for it. He said $800, and I said, well, why'd you buy it? This was right before the New Year's. And he said, I had to buy something before December 31st because my CPA told me I was going to be in a high tax bracket and I needed some deductions. I asked him how much he saved. Now, he figured he was in a 40% tax bracket, so he saved about $320. That meant that he paid with his money $480. So then I asked him, if it was on sale for $480 and it was not tax deductible, would you have bought it? And he said, no, I bought it for the tax deduction. Now think of the logic. He took a mental shortcut on the tax deduction side. He paid $800 for it. He got a 40% tax deduction, so his net cost was $480 after he got his tax savings. But he wouldn't have paid $480 for it if it wasn't tax deductible. In other words, based upon his own reasoning and his own answers, he would not have purchased that. I talked to another doctor who owned tax-free bonds at 4%, maybe $500,000 worth. And he was a young person accumulating money to $70,000 or $80,000 per year. So a lot of money was going into these assets, all tax-free. And I asked him why he had tax-free bonds, and he said, because I hate paying taxes. Now, as we looked at his return, his adjusted gross income was about $140,000 after all of his deductions and a building that he owned and so forth. And this is very common, by the way. A lot of people don't want to pay taxes, so they'll pick an investment where they're going to defer on taxes, even though from an investment standpoint, it wasn't the best return. The reality is the important question is, net of taxes, which investment is going to yield more money in my pocket? And so as in microeconomics, we walk the numbers and we just walk through and say, okay, he was in about a 25% tax bracket. So he got his 4% versus, and this was at the time I think this was an A-rated 10 or 12-year bond maturity, not callable. And when we comped it out, we were looking at about a 7% A-rated. This is municipal bond. We could have bought a corporate bond at 7. Now, when he takes out his 25%, he's still netting over 5% on the corporate bond. Now, is it better to gross 7% and net 5% after you pay taxes, or even 5.25%, or is it better to gross 4%, pay no taxes, and so your net is 4%? And the answer is real simple. I want to talk about why the cost is almost insurmountable. Let's suppose that this gentleman with $500,000 continues to do this over the decades. And 3 years from now, he's got $700,000 in there because he's adding rapidly. And 20 years from now, he's got $3 million in there. $3 million growing at 4% versus $3 million growing at 5% is a $30,000 difference net in his pocket. Now let's just say over time the average is half that amount, $15,000 a year. Over 20 years his principal cost is $300,000 in lost dollars, but the lost opportunity, in other words the $300,000 had it been invested in that period of time, would be perhaps double or triple that amount. So this small mistake of letting the tax tail wag the investment dog cost this doctor about maybe $500,000 to $1 million. Cost this doctor $480 that is now no longer in his pocket. That certainly that device he had 10 years ago when we spoke is worthless now. But how many other things is he doing that? How many other things is he buying so that he can get a tax deduction? When you're looking at what you should be investing your money in, look first at the net return and look second at how much money goes to taxes.